Hello everyone, Rahul Shah here, trying to make investing accessible and profitable for the average investor. What do you feel about buying a stock that's trading at a PE multiple of 85x? Well, for value conscious investors like me who believe in following rules and having strict upper limits for valuations, I will simply give the stock a pass. A PE of 85 is quite high and does not offer margin of safety of any kind. Now, having said that, one needs to check whether the denominator of the PE ratio, which is the earnings, are not abnormally low. If they are, then the PE ratio may not be a true reflection of the current valuations of the stock. Now, a quick glance at the company's P&L statement reveals that the earnings being considered for the current PE ratio of 85 are not low at all. In fact, they are one of the highest that the stock has managed to achieve in recent years. Therefore, the stock certainly looks overvalued from a historical earnings perspective if one considers the PE ratio. Now, it is not cheap on a price to book value basis either, as the ratio currently stands at a huge 35x. To be honest, the only stocks that are commanding valuations of this kind are extremely high quality companies like Titan, Pidilite, Asian Paints, etc. These are stocks with amazing long term track records, solid franchisees, and great returns on capital. But fact limited, the stock under consideration today possesses none of these qualities. It has posted losses in 5 of the last 10 years, turning profitable only in FY19, had negative net worth for all the 10 years barring FY22 and FY23, and had debt significantly higher than what its operations could handle. If the historical track record of the company paints such a sorry picture, why is the stock going all gangbusters? To put things in perspective, FACT was trading around the rupees 25 mark back in March 2020. From there, the price has jumped to close to rupees 750 per share, translating into a whopping 30 bagger gains or 2900% gains in under 4 years. Now, truth be told, the stock did deserve to be re-rated. After all, it has managed to turn its operations around and become a profitable entity from a non-profitable one. Besides, the company's future also looks promising. FACT is the leading fertilizer supplier of Kerala and also supplies fertilizer to all the South Indian states. Its operations are also marked by a high level of vertical integration, as its ammonia requirement for fertilizer manufacturing is met through captive production. The company also has robust expansion plans lined up as it targets increasing the fertilizer production from 10 lakh metric tons to 15 lakh metric tons. Having said that, it is not completely out of the woods yet. The biggest challenge it faces is an outstanding loan of almost rupees 18 billion that it has taken from the government of India. Additionally, the interest accrued on the same stood at rupees 12 billion. Now, as per the company's credit report dated March 2023, it has requested the government of India to write off the loan interest, convert a portion of the loan into equity, and change the balance loan amount to interest-free loan repayable in 10 annual installments starting from FY23. Then there are other long-term challenges like regulatory risks and the dependence of the fertilizer sector on the vagaries of the monsoon. Therefore, if I were to summarize, there has been a marked improvement in the long-term fundamentals of the company. However, are the improvements so good that investors start treating the stock like the way they treat world-class franchises like Asian Paints, Titan, and Page Industries? Well, I don't think so. Fact still belongs to the fertilizer sector, whose long term history of wealth creation is average at best. We haven't seen too many investors earn multi bagger returns from fertilizer stocks over a 3 to 5 year horizon. Therefore, giving a P multiple of more than 80x to a stock like Fact is taking it too far, I believe. Another way of analyzing this is considering the valuation its peers trade at. Now, the long term average PE across most of its peers like GSFC, GNFC, Chumble, and National Fertilizers are in the range of 10x to 15x. This makes Fact's PE ratio close to 7 times as expensive as peers. Put differently, Fact will have to grow its earnings by a huge 600% in the near future to bring its valuations in line with its peers. And this sounds very difficult to achieve, if not impossible. You see, the future is always uncertain, and there is no telling how a company will perform in the future. However, the past performance of not only the stock but the overall sector as well can certainly act as a guide for the future. Therefore, if you want to practice sensible investing, you should not be too adventurous and assume that the future will show a marked deviation from the past. In fact, you should buy at a price where even if the future is slightly worse than the past, there isn't too much damage to your invested capital. So when you look at Fact's share price from this vantage point, it has an extremely rosy future built into it at the moment. And I don't like such situations. For if the rosy future that is built into the share price of Fact does materialize, the stock price does not move up too much as it is already built into the price. However, if the future turns out to be thorny instead of rosy, the share price can take a huge knock and cause substantial damage to your capital. Therefore, I will definitely proceed with caution as far as the current share price of Fact is concerned. That does seem like the safe thing to do for now. So this brings me to the end of this short video. I'll see you again next time. Goodbye and happy investing.